Today, I'm going to give an overview of the first 3 months of 2024 and what that means for average investors in the UK. And I'm also going to try and give you a framework for how you can use that information to make better investment selections and to make your portfolio work for you. The start of 2024 has been generally positive for investors. So if you're a lower risk investor, invested mainly in bonds, you've probably made about 1%. And if you're a higher risk investor, invested in the stock market, you've probably made about 5%. Over the last 12 months, lower risk investors would have made about 5% and higher risk investors about 10%. So overall, I think these are excellent results and pretty much in line or ahead of what the average investors in each case would have been expecting. Now, what's driving this is more optimism about the global economy. And that's having different effects on the two asset classes. The returns on bonds are really coming from yield right now. So the average yield on a bond portfolio is probably about 5%. So if you make 1% in the quarter, you're pretty much in line with what you would get just from the yield alone. So the actual price of the bonds hasn't changed much. There has been a change in tone in the bond market in the last few months though. As expectations of economic growth have improved, worries about inflation have increased, and that has put a little bit of downward pressure on bond valuations, and that's definitely something that we need to continue watching. If you're an equity investor, really the message has been sort of general global optimism. So the US has continued to perform well. Europe had a good first quarter. Japan had a fantastic first quarter, the leading area to invest in the world. And China has turned around and started recovering as well. So this general optimism really has led to more risk seeking for equity investors, which has been a good news for higher risk investors in the quarter. So when thinking about equity market returns, it's really helpful, rather than thinking it's some kind of will-o'-the-wisp, maybe it goes up, maybe it doesn't, into actually realizing that returns are broken down into 4 parts: dividend yield, inflation, growth above inflation in the underlying companies that you're buying, and any change in valuation. If we look at 2 markets which people tend to compare, one we know obviously well, we live here, which is the UK, and the other one being the US. So thinking about those markets, the UK has a high dividend yield, the US has a really very low dividend yield, especially if you adjust for stock-based compensation. Valuations in the US are high relative to their history, and valuations in the UK are low. So if you think about the UK and 8%, 3.8% dividend yield, 2.5% inflation expectation, 6.3%. So we only require, assuming valuations don't change, 1.7% growth. A globally diversified index like the FTSE 100, that is quite a lot lower than global GDP expectations. So I think we can say, actually with some confidence, that the UK equity market is likely to hit those expectations. So looking in the US in the same way, dividend yield's about 1.3%, but if you adjust for the effect of stock-based compensation, so companies using their cash flow to buy back shares that they've given to employees to keep the share count level, real dividend yields are probably closer to 0.5%. So 0.5% plus 2.5 is 3, and then you need 5% from growth. Now valuations in the US are high, so if anything, the risk in valuations is that there'll be downward pressure on returns, and 5% in the long-term growth ahead of GDP, ahead of inflation, is a big ask. So I would look at, in using this framework, look at the US, and we think that, of course, it's possible it may achieve 8% returns. And we can't say exactly what the returns will be in the future, but we can say with confidence that getting to those returns is quite high risk. The UK actually aligns much better, in our view, with those return expectations than the US market does today. As always today, I've been talking about investments, so you must remember that your capital is at risk. If you have any questions about what you've heard, please get in contact with me. If you do have watched this and you've enjoyed it, it would be great if you like the video. That does help us with visibility. And if you don't automatically get the videos, click on the flying colours icon and you will be added to the list. Thank you.